You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Thank you for tuning in to the Generational Wealth Through Commercial Real Estate show. We got a very special guest lined up for you today. But before we get into that, if you're watching this show for the first time, do me a favor and go ahead and hit the subscribe button. I want to keep growing this show, and you guys subscribing, really motivates me to keep bringing on rockstar guests like I have today. And if you haven't left a review, go ahead and leave me a review. These reviews are how I'm able to gauge how I'm doing. And it also helps with bringing on people like Josh today, because, they want to come on shows where they feel like they're going to be heard. So, help me out there if you can. All right, so the housekeeping is out of the way. Let's go ahead and get to today's show. Today's show guest is Josh Plave. He is the CEO of Wall to Main. Last year, they syndicated a deal in Lubbock, Texas, and it was 173 units. And what Josh focuses on is raising capital. And today he's going to be talking about raising capital, how to use our retirement accounts to get into deals. So I'm very excited about hearing this show today, man. If you would, Josh, tell us a little bit about who you are.
Yeah, thanks for having me. I started, a lot of folks wonder why a guy who's only 30 likes to talk about retirement accounts and how they, get invested into real estate. And I started investing back when I was 16. I opened my first Roth IRA after I was a camp counselor for a summer. And my mother and my grandfather were both CPAs, and they kind of instilled this future thinking, forward thinking concept in my mind that you should really focus on your future self. So I figured I had already paid the taxes. I'll put it into a Roth IRA and get investing. And so I invested in what I knew at the time. That happened to be aviation. So I put it in a mutual fund and just kind of, let it grow from there.
Now, hold up. Let me pause you there for a second.
Yeah.
Because, I have kids. I got 4 of them. I got a lot of kids running around. And my oldest, she's 15 and be turning 16 next year. So what are the rules around, your teenagers investing in, Roth IRAs? What are the stipulations behind it?
There really aren't any. You can open an account for them at any point and get started. My dad kind of, he fancies himself some sort of wizard investor, but he would, he'd break out the old charts and everything before things were on Yahoo Finance, readily available online. And he'd kind of break out these huge books and show me, the type of funds you should get invested in and all that, and take a look at fees and everything. And I kind of had an idea of, you want to make sure that folks aren't taking your hard-earned money through fees, and you want to make sure you're exposed to a broad swath of, whatever market you're investing in, whether it's stocks and equities, whether it's real estate. You want to diversify across the board to make sure that you're not, in a large way exposed to one particular event. Right.
Gotcha. Sorry about it, man. Keep going.
Oh, not at all. So, essentially a few years, let's say 10 years after I had opened that account, actually my mother and my grandfather both passed away. And so what that did was it left me with, the retirement packages of a baby boomer and a member of the greatest generation. And it wasn't a life-changing amount of money, but it was enough that I needed to understand how I was going to kind of steward their legacy and make sure I preserved it and didn't just blow it up all in one shot. So I knew at the time I wanted to switch careers over to real estate. And so I started taking a look at what I could do within real estate surrounding my retirement accounts, found out that I could use a self-directed account. And that's kind of how I got started. In the last few years, I've kind of collected all of the different bits and pieces of information that are kind of scattered throughout the internet, and ended up understanding exactly what it was going to take and how to, to build, a multifamily operation through my retirement accounts. And so I kind of took all that information, built it into Wall to Main, and now I like to help other people, have all those resources in one place and understand how they can get started.
Yeah. Now, for the person that's listening to this that is hearing about the self-directed IRA for the first time, what would you tell them as far as, allocation wise, what percentage should stay in the markets as far as mutual funds, and what percentage they should bring into the self-directed part of it?
Yeah, so that's, everyone has a different kind of risk profile.
Yep.
And so it's really down to, in my opinion, it's down to experience and age. For me, when I started doing this with, before I even did self-directed and I was doing, just retirement accounts or just, normal stock investing, because I was young, I went riskier. I was okay with, with things that were I knew they were going to be a little more volatile, but I was okay with a larger potential upside, with a larger potential downside, because I knew I had time to make up for those losses. And
Yep.
so you need to kind of evaluate where your risk profile is at. And if you're comfortable with going all in on one thing or splitting it up 50-50, or really how much you need to leave behind. And another thing to really think about is, I would highly suggest you don't approach it this way. But if you ever do need to use your retirement accounts as kind of a safety backstop, if you think that you might need to tap into 10, 20, $30,000 in case of an emergency, when you do invest in a multifamily property, it's pretty illiquid, and so it's difficult to get out of. So if you think there's a potential for you need to kind of blow up a portion of your retirement account, leave that behind in a typical IRA where you're going to be invested in mutual funds and stocks that will be able to trade and be liquid within 2 to 3 days. And that's kind of the barometric, where you're leaving things at in terms of a split between illiquid versus liquid assets.
Gotcha. No, that makes a lot of sense. All right, man. So tell us, why did you decide to go with multifamily over like mobile home parks or self-storage?
Yeah, so I kind of, when I jump started into it, I was coming at it with a fresh perspective. I hadn't flipped, I hadn't bird, I hadn't done any of these kind of things, and
Yeah.
so I kind of took a step back, and I was able to do what I called like a self-taught curriculum, where I listened to podcasts like this. I attended every meetup, I read every book, went to webinars, all kinds of
Right.
stuff. And I kind of looked at the real estate industry as what niche do I want to go into? Originally, I thought I was going to go into flips, and I was going to do all of that. And I soon realized it's A, not scalable, and B, it's pretty difficult to do with your retirement account, because if you buy a property to flip with your retirement account, you can't actually go in and do any kind of sweat equity. You can't swing a hammer. So
Right.
you need to manage the property, but I need to find a good GC crew who is going to be able to take care of everything. And it was at the top of a cycle here in Denver, where I tried to get this, the wall that I'm sitting behind.
Right.
I tried to get this thing finished, and it took me 3 months to get a contractor who wanted to do a job. And
Wow.
when you live in a hot market and you don't have a good GC team, it's just kind of out the window. So I knew when I was going into it, I was going to want to scale. Everyone says, you go 2 units, then 4, then 8, then 16. And so I knew I was going to cross that threshold into commercial at some point. And, my eventual multifamily mentor, he gave a speech that I was listening to, and he said, as soon as you cross through 5 doors, 5 doors and 90 doors, while the scale is different, the closing process is identical. There's more people involved, but it's the same paperwork. It's the same type of loan in terms of executing the deal. So that was kind of the light in my head, the light bulb moment in my head, where I was like, okay, I know I want to go into multifamily. I'm not sure why I went for multifamily versus self-storage or anything like that, but I knew I was interested in residential and kind of improving tenant, livelihoods and giving them amenities and things like that. So that kind of spoke to me, and I ended up going directly into that path.
Right. So let's talk about how you, you went from deciding to do multifamily to doing a 173 unit deal. So tell us, how the heck is that even possible?
Yeah, it takes a village. I mean, you can throw those kind of terms around, but multifamily is really a team game, and it's difficult to jump in as a newcomer, because they, Fannie Mae and Freddie Mac, they require all kinds of, experience and liquidity and stuff to sign on a loan. And so if you don't really have that, you're going to need a partner up with people. And I know I was lucky enough that I found a great mentorship group that I was able to join. And so I kind of had this built-in network, but that's one of the options that the roads that you can go down. That you can essentially, I wouldn't say it's buy your way in, but it's an opportunity to really meet a group of like-minded folks who are all gunning for the exact same ideals. And so that's what I did. We have a coach, but more importantly, I have 70 folks in the group who are my built-in network that I can start communicating with. And so, through various events back when we were doing them, I was able to go and meet people face to face across the nation who I never would have been able to meet necessarily. And we partnered up, and then eventually they brought a deal that I liked and was able to get involved in.
Yeah. So to the listeners, I want you to really take away those two key points from what he said. The first one was, it's all about networking, because, multifamily is a team sport. I don't care, how big and bad you think you are, but, at some point, you're either going to run out of cash or you're going to run out of time. And you're going to need somebody to partner with you on these deals, especially when you start going on larger deals. So networking is number one. And then number two, he mentioned that he joined a mastermind. And yes, these masterminds typically have a cost associated with them. But what you are buying access to is, people that have track records, that have closed deals, that are able to go out and raise money. Whatever it may be, it's typically in these mastermind groups what you need to get a deal done. So I wanted to really, make sure you guys really heard what he said, because that's very important. Good deal, man. So, so you go back to doing this first deal. What was it about the deal that you really liked? What is it that you've seen? You say, okay, man, 'cause I know when those deals, a lot of deals come in front of you, and you got to really cherry pick the ones you like. What was it about this deal that you liked so much?
Yeah, there were two things. The folks who found the deal, so it was in Lubbock, Texas, and they live in Fort Worth. And it was a father-daughter team, and the daughter, I believe, went to college in Lubbock. So she was very familiar with the town. Yep. So they had deep connections, and they had been kind of hunting down this. It's a portfolio. It was 2 properties. They've been hunting it down for about a year. And so they really knew the area well. It wasn't kind of like a broker passed a deal in front of them and on a whim they would put in an offer. They had been specifically hunting down these 2 properties for over a year. And so I really liked that they were so passionate about this exact project. Right. And on top of that, as I mentioned, it was 2 properties, and these properties happened to be about 2 blocks apart from each other. And they previously were operated totally separately. They really didn't have any kind of similar operations or joining expenses. And so what we were able to do, aside from everything, it was pretty, typical value add property, but we were able to combine a lot of expenses because one was about 90, one was about 80 units. And we were able to kind of combine maintenance personnel and advertising budgets and things like that were really able to drive down the cost on a per unit basis across both properties. Yeah.
All right. Okay, so I'm not gonna go too much more into that. I want to ask you some more questions, but I'm gonna wait until we go to the deal deep dive. All right, so you said you got into this deal, and I imagine you coming into the deal, you being a capital raiser, you was able to bring capital to the table. Now, was this all of your capital, or were you able to raise money from other friends and family as well?
Yeah, it was my first, so it was friends and family, and it was nice that I was able to. I've been talking about multifamily for about a year at that point, and it was nice to be able to bring them into the fold and have them along for the ride.
Yeah. Now let's talk about that for a moment, man. There's other people that's listening to this show that they don't have the experience, but they may have a network that they don't even know about. So, people that's trying to raise money, man, what tips or advice could you give them right now?
Yeah, it's interesting. I never thought I would have gone into capital raising ever. I vehemently was against it. I'm by nature an introvert. Yeah. And so I really didn't want to come off as salesy or seem like I was trying to push something onto people. I ended up getting more comfortable with it because I found my niche, and my niche was I specialize in retirement accounts. I can speak to a specific approach to things. Right. And once you get familiar with kind of your angle and why you like it and the story behind it, as long as you come at it from the mindset of I'm presenting people with a chance or an opportunity or something that could potentially change their lives, right, and you're not really like trying to sell them on a hot or something like that, and you change the way that you're okay if they invest, you're okay if they don't invest, it's up to them. You don't necessarily need them because there's you can talk to somebody else, but you just want to make sure that they were aware of it. that's kind
Yeah.
of the mindset that changed things for me.
Gotcha. So, I mean, that's a very interesting point. You coming from a position of, helping people, like the kind of the go-giver mindset of, hey man, I'm giving you an opportunity here, and it may make sense for you, it may not, but there's no pressure either way. We're still gonna be friends when we leave the table. When you're approaching with that mindset, it makes a huge difference. They talk about having commission breath. I'm a broker, real estate broker. They talk about having commission breath, and those property owners can smell it, man. If you come in there thirsty, they're going to take advantage of you, and they're going to say, okay, this guy definitely, he wants us too bad. Like, I'm not working with this guy. It's the same thing. If you're trying to raise money for somebody and you seem desperate, like, man, come on, do this deal, man. It's a great deal. You're probably not going to get any money at all. So that's really good points, man.
Yeah. Yeah. And with the, the salesy approach, not only will you have less success, but you'll probably also be more damaging to your relationships. So if you're more comfortable with giving them the opportunity to make a decision on their own, you're still going to preserve your relationships, and you're going to be more successful at raising capital.
Yeah. Absolutely, man. So markets wise, man, what markets are you looking at now as far as, obviously 2020 happened, and it's, craziness, but, moving forward, where are you planning on investing at?
Yeah. So still huge fan of the Texas market. It's, something that I would be open to investing in, but personally, once I start back up in acquisitions next year, I'm all about the Carolinas. I love the job market there. I love the broad economic sectors that are supporting it and the overall future growth for it. So a lot of metrics that go into it. I'm big fan moving there soon, and hoping to jump back into acquisitions now that I've established my capital raising business.
Yeah. Well, I'm gonna put some deals in front of you, so
Look at them.
Yeah, absolutely. Now as far as deals go, what is the ideal like unit count, class of the property? Like, what are you looking for there?
Yeah, the partners and I that I work with, we typically look for somewhere between, like, we'll go with 90 units up to about 250, something between $5 and $15 million. Looking at, Class B, Class C plus, the typical value add workforce housing. The three level apartment buildings, stuff like that. Not too vintagey, going back to the late 60s maybe.
Right.
If it's in good condition, but looking for deferred maintenance on a manageable level. I'm involved in as a passive investor on a very deep haul in Memphis, Tennessee, and that's the kind of project that I love to see. But typically you look at properties that are, you're just going to fix the parking lot, or you're going to fix some leaky, toilets here and there, just drop expenses, things that you can really, replicate over and over.
Right. Gotcha. No, that makes a lot of sense. Now let's talk about underwriting. When you're underwriting a property, what are the red flags you look for to say, okay, I know this is not a deal for us?
Well, for me, specifically, I'm now, because I've shifted to, helping folks with their retirement accounts, I'm specifically looking for opportunities that are aligned for retirement. Gotcha. When you invest with a self-directed IRA, you incur potentially taxes. The self-directed IRA incurs you taxes, and we can jump into it later. But essentially, what I'm looking for, I had a few deals come across my table, in the past month, and they just weren't the right style. You were probably asking about kind of like what is going into the property, what types of work is going into it, and at this point, I'm more looking for the flavor of something. Is it something that is going to be enough of a value add where we can actually acquire bridge debt, where we can go into it, not worry about a prepayment penalty, reacquire an agency loan somewhere into the 3-year range, and make sure that we can get a return of capital back onto our to our investors before they're taxed in the end. Go ahead. Sorry.
No. I just want to ask you a question around that. What kind of taxes should investors be looking or thinking about if they're going to be using retirement accounts?
Yeah, so I mean, most people are probably wondering what the hell I'm talking about, because most retirement vehicles are totally tax-free. But When you do use a self-directed IRA and you're investing as a passive investor into a leveraged asset like multifamily, what happens is, the IRA is essentially supposed to, it's a tax-deferred vehicle that's supposed to incentivize you to invest for your future self.
Right.
And so when you're investing in a leveraged asset, your tax-deferred dollars are benefiting from the bank's non-tax-deferred dollars. So if most properties are, let's say, a 25% down payment, the equity you're bringing in with your IRA, the income that comes in on that 25% that you've supplied is totally tax-free. And when you go and take money from a bank, from an outside source, that money has to be taxed because it's not in an IRA, it's not being tax deferred. So about 75% of the income in that first year would be taxable. And that's called unrelated debt financed income, or UDFI. And when the nice thing is when you do have to pay these taxes, you're actually able to use the same percentage of expenses. So you can actually use 75% of the depreciation that year, the operating expenses, interest expenses, stuff like that. And it helps to offset things. So the nice thing is for your cash flow, you're typically going to offset things for the first 3 to 4 years. And you really only see the big bill in that, if a hold is 5 years, you're going to see it on the 5th year where you have the capital gains. And so I'm specifically looking for opportunities that will have a refinance before those capital gains hit. If you invest 100,000 and you get refied 50,000 back, you can go and put that into another deal immediately before you're ever taxed.
Yeah. No, I got you. Now that makes a lot of sense. Makes a whole lot of sense, man. And it could be a game changer for a lot of people that's looking at using self-directed IRAs. And if they didn't know about this strategy, definitely going to be helpful. Now, tell people, man, how can they get set up with a self-directed IRA? Where do they go find out more about how to set one up?
Yeah, it's an interesting conundrum, and honestly, one of the main reasons I got involved was most of the education that comes within this space is done by the custodians themselves. So we typically all have our retirement accounts at places like Vanguard or Schwab, and they can only handle stocks and bonds. That's what they're set up for. But there are other custodians out there that are lesser known, and they can do real estate, like we're talking about. They can do cryptocurrency, gold, all kinds of things.
Right.
And so you're going to end up moving it into that custodian. And a lot of these custodians, because they're selling accounts, they're out there educating. They're at the meetups, they're at different events and things, and they're telling you about the accounts they can offer to you. The thing is, they're actually not telling you the full perspective. And the reason I started my company was because I wanted to let folks know what their options were beyond just a custodial account, because they tend to charge a lot of fees. They tend, as I mentioned earlier, you want to make sure that people are not putting their hands on your account balance and affecting your overall returns. And they're incredibly bureaucratic. So there's also an option called checkbook control, where it actually adds a second layer, but ends up reducing the complexity of the overall account. So you do open a custodian account, but at the same time, you've actually got a company who's going to set up an LLC for the IRA. And so the IRA then invests 100% of the funds into that LLC, and then you're managing that, and you can open up a checking account from there. And so I like to joke that you can find a deal at breakfast and fund it by lunch, but it makes things really, really quick. With a custodian, it can be up to 3 or 4 weeks. With a checkbook account, I literally can do it within hours, and it's just a wire fee of $25 or $35, whatever it is at the bank, and it keeps things nice and nimble.
Yeah. No, that's really, really good advice. I appreciate you sharing that. All right, man, let's go ahead and segue to the next segment of the show. Let's talk about that deal in Lubbock. You talked about how many units it was 173, right?
Yeah, at the time it was.
Yeah. So what's the value add strategy you guys are implementing on it?
Yeah, so one of the things, the reason I said at the time it was, one of the things we really liked about it was on the property walk, we were able to find out that there were enough, I think there were like empty maintenance spaces there's 5 buildings. And so each building had like a maintenance area that wasn't really being used and could actually be turned into an efficiency. Yep. So we were able to add 5 units, which I believe added about $1.5 million of day one equity. Well, it wasn't day one equity, but eventually equity built it out. So it's in the process of being turned into a 178 unit property.
Nice.
Yeah. After that, it was about $7,300 rehab cost per unit. across the two properties. Each one, they were kind of a different mix. One was kind of a B plus, or sorry, a B asset. One was a C plus asset. And so we were targeting two different kind of finish levels, but they were roughly, each about quarter of the way finished. They had proven, upgrades and rental potential. And so we were just kind of finishing out those things. And after that, it's just been typical stuff like roofing. COVID was not too kind to us with supply chain at the very beginning. If anyone remembers, it was hard to get supplies and stuff from China, and our roofing supplies were a little delayed, but we eventually got the project done, which is nice. But beyond that, it was the pretty typical value add.
Gotcha. And what's the what kind of debt did you guys go with for this property?
Yeah, this is it was a bridge loan, so I think it was a 2+1. And I forget what the interest rate was. It was in the 5s, but it was nice enough that we were able to kind of bring things up, and then hopefully we can find some agency debt in 2021.
Gotcha. And was the exit is to refinance into agency and then hold it long term, or sell it in 5-10 years after that?
Yeah, the whole plan is 5 years, but typically we execute the two strategies that everyone does, where you say what you're going to sell it for in year 5, but you also are open to refinancing in year 5 and holding in perpetuity. Everyone keeps their share from there on out, and we're all at infinite returns, and you just keep going until you find a buyer who wants to take the property for a good price.
Yeah, absolutely. Good deal, man. All right, man. Let's go ahead and segue to the lightning round. All right, couple questions for you. Ready?
Yeah.
All right. What's the best advice you ever been given?
The best advice, the first one that comes to mind, I'd say, is focus on one particular topic. There's a lot you can do across real estate, and if you're listening to this, you're probably pretty geared into multifamily, but there's a lot of shiny object syndrome. And once I got the idea that you really need to focus on one particular topic and master that one topic, it was really powerful, because you can really become an expert on that one thing, and then you have time to transition and pivot beyond that. But it's key.
Absolutely. Best book you've read this year?
Best book this year, Blue Ocean Strategy. It kind of is a book that gets you to look beyond the markets that everyone else is competing for, and it puts you in a mindset of kind of creating your own markets, bringing a product to market that is going to be wildly different than anything else that someone else has brought. And so it really got my creative juices flowing in terms of what I could offer, folks around me and different businesses I can open up.
Yeah. Awesome. Definitely check that one out. What are some rituals you have created that's making you a better investor or a person in general?
Yeah, the most impactful one has, I don't execute it fully, but the Hal Elrod morning, I forget what, Miracle Morning. Yeah.
Right.
It's I like I said, I don't do every particular aspect of it. I used to, but it really, getting my morning regimented and going in a very constructive manner has really jump-started everything. Because if I didn't do it, and then the days where I don't find myself doing it, I start off floundering and I don't get as much done. But if I'm able to come through and execute the first thing in the morning with power and kind of an energy that I was able to generate in the first 2 to 3 hours of the day where I dedicated it to myself, I'm able to be a much better me. Nice.
What's one thing you're focusing on right now to improve your business?
The one thing, a lot of people answer this, but I go with systems. The thing that COVID really taught me is, when I first got into capital raising, I thought I was going to be going to events and networking and shaking hands and meeting people. And COVID really, slapped me in the face and taught me that I need to do something different. And it was actually a great opportunity, because it let me automate things. It let me, create these repeatable tasks.
Right.
So it's nice being able to communicate with investors, communicate the value of what I'm doing, what they have, the potential to join into, without having to be there to shoot off the email or to write the very custom email to them. And it's been very powerful in terms of scaling up my business.
Right. If you can give your younger self one tip in regards to investing, well, obviously you started at 16, but what would you tell the 16-year-old that you've learned?
Honestly, I think just keep at it. I think I started off right, and I'm very happy with how I started. But it was incredibly powerful to start young, and I think the value in starting young is continuing from there. There's only so much benefit you get from just doing it to say you did it. If
Right.
you continue to add $1,000, $2,000, $3,000 every year, that compounding value of always looking out for yourself in the future and not spending your dollars today, but making sure that future you is not, unaccounted for.
Yeah.
I think that's the most powerful thing you can do.
Yeah. I agree with you 100%. What's the worst job you ever had?
I haven't had any terrible jobs, but the reason I switched over to multifamily was purely because I was working in business operations. I was an analyst and I sat in Excel all day. I used to work for a company called Dell EMC, who was a cloud computing company, and I would crunch huge data sheets, and I would work on all kinds of projects that I would ship off to some middle management, who would ship it off to a upper level management, and it ended up something happened with it. I don't know what happened with it.
Wow.
I never saw what happened with it. And It was so frustrating to work my ass off and never see the results. I never saw it hit the light of day, and I'm sure it did something, but I don't know what it was. And I need to see direct physical results, which is why I do real estate, because I can literally see my dollars hard at work and see updates with them, which is really rewarding.
Yeah, absolutely. No, I couldn't imagine it. Oh my God, I was shooting myself in the face. All right, last question, man. Your rich uncle leaves you $1 million, man. What are you doing with it? It's tax-free money.
Tax-free money, $1 million. I honestly would do what I do here. I would just passively invest it, and it's such a boring answer, but letting somebody else manage it is a lot better than worrying yourself. If you got $1 million out of nowhere, out of the blue, it's going to be a lot more effective if you let someone very quickly put it into action for you than you try to learn everything A to Z, put it into effect yourself, and get 5% more. I mean, if you're not an expert on it the day before you got the $1 million, let someone else take care of it for you.
Yeah. 100%. All right, man. Well, we're at the end of the show. Tell my listeners, how can they get in touch with you?
You can get a hold of me at walltomain.com, where I have kind of a whole, database of things that you can learn, of ways you can use your retirement account to get started. I also offer a free PDF called the Top 10 Tips and Tricks when investing passively in multifamily with your retirement account. And it kind of gives you a bunch of, unknown tools, you could say, for how you can potentially get started in ways that you never thought you'd be able to.
Awesome. Well, man, we appreciate you coming on the show today.
Thanks so much for having me.
Absolutely.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.